Ora si registrerà la conferenza.
So I think that we can start.
Okay, no, I don't know.
Please.
But just very quickly. So thanks for everyone for being, connected today. Maybe when you intervene, it's nicer if you want. There is no obligation also to show your face, but otherwise, you put a mute just to avoid problems. I'm happy to be here, even if only for some minutes, to open basically this series of webinars that they come from. Unfortunately, we couldn't hold our annual conference with BOCCONI and ESMA that I think has always been very interesting in terms of food for thought, coming from very important and well-grounded academic papers, but actually with also a lot of insight in terms of policy implications. And I often quote some of the papers that of the past edition. So we decided in any case to have this sort of instead, given the fact that we couldn't hold the conference, which was scheduled to be, unfortunately, when it was March. So we really deep in the first dramatic period that we had, and typically we had in BOCCONI, so in Milan, so one of the most affected areas. So where today we will basically present in the next, I would say, 10 weeks. So by the end of January, all the papers that have been already selected for being presented at the conference, and so it's I think they are already by definition very good papers, very interesting in the different areas we had decided to organize the conference this year. And so in different areas, markets, intermediaries, but also issuers, proxy advisors. So I think is a broad selection of papers, quite interesting. We start actually today. I'm very happy with Loriana Pelizzon, and on a very interesting papers also, which I think is relevant. And so I'm really sorry not attending, because I have a more boring meeting on with the ECB on post-trading issues, but actually this is very interesting because it's about the discount, but actually the importance and the comparison of OTC trading and also regulated market is actually also at the center, as Loriana knows. Also, she's a member of the advisory committee board or scientific committee of the ESRB of actually, I would say, the policy debate that we're having in Europe. Since a long time, but even in these weeks, I would say in these hours, all the debate about the consolidated tape, what is price discovery, do we have more trading in a sense, so trade creation or trade diversion from the regulated markets when we have crash or accident in the markets. And we had the Euronext a couple of weeks ago, we had Eurex some months ago. Really, should we expect that then all the trading maybe is diverted from the regulated market, maybe closed, or whatever trading platform is closed in that moment to the others, or not? And we have also different empirical evidence. So I think it's going to be a very interesting presentation. And as you heard, maybe Loriana can speak 20 minutes or whatever, then having interaction even during the talk, and then obviously at the end. So I thank all of you to be here. I see there are also people I see here from ESMA and others. So Loriana, thank you very much, and then also we are in touch afterwards. And I give the floor, I think, to Nadia. And so also thank you for being here. First seminar of all the series, and then very interesting all topics. Okay, thank you very much, and bye-bye.
Good, thank you. Thank you very much. Loriana, the floor is yours. I don't want to steal any minute to your presentation. Thank you very much.
So thank you very much for inviting me and selecting originally, the paper. that actually we just revised. So I'm also adding new results with respect to the previous one. And I'm very curious to know also comments on it. So let me find out this, share, good, and then go back here. Okay. So I hope that everybody are able to see it properly.
Yeah.
Yes.
Okay, very good. So as you can see, this is a joint work with Caleb Derour, that is now at the Central Bank of Australia, but he was in Frankfurt. And then Emmanuel Monk, that is the head of the research department of Bundesbank, together with Michael Schneider, that is also, by the way, present today. And we are largely using data from Bundesbank. So clearly the usual, let's say, disclaimer, mostly for Caleb, Emmanuel, and Michael, are provided. So what is this paper doing? The title is already, let's say, intriguing, is over-the-counter discount. That is something that usually you are not having in your mind. Usually the idea is that, over-the-counter market is very inefficient and, you are paying a lot of transaction costs and so on. But let me go more in detail. So the focus of this paper is on inter-dealer market of the German Bund. So clearly a market for the risk-free asset that is one of the most risk-free assets in the world. And the first question you are asking, on investigating this market is if the Bund that is traded both in the exchange and over the counter is showing over the counter an OTC premium or an OTC discount. That is it paying a price at the bid side, let's say, in order to buy, that is larger in the exchange or over the counter? On the other side, the other second question that I think is also interesting to understand is, when is a trader, when is a dealer, by the way, deciding to trade either in the exchange market or in over the counter? And then over the counter, he has still several other options. One is to trade bilaterally with another dealer or via a broker. And the question is, when is it trading with a bilateral trade or when it is doing it via a broker? So clearly, what we are going to show is pretty much the cross-sectional dispersion of prices between exchange and over-the-counter segments, and then also what are the differences between bilateral versus broker-facilitated trades. And clearly, we are relating all the evidence that we are observing to, let's say, the classical reason provided theoretically in this literature, that is search cost, inventory, asymmetry of information, trade size. And then, since we observe also the D2C market, so the dealer to client market, and we know that the dealer is trading in one market, so interdealer, with a certain discount or a premium, and we are asking how much is transferring of this, let's say, trading facility in the interdealer market to the D2C market. So how much the D2C market depends or get a benefit on how the interdealer market is working. Because, the existence of the interdealer markets, it is justified mostly because of the dealer to customer market. The final customer are the one that pretty much we need to care the most. So just to give an idea of what I'm talking, I'm sure that, in this case, I have an audience that know very well how the market is organized, but pretty much the key idea is that, this type of market is characterized by dealers that interact among each other, and I'm marking it as the yellow circle interdealer market D2D, but they are trading with their customer under different facilities, either bilaterally or using a multilateral trading platform. So they can trade directly by voice or electronically in the multilateral trading platform. But the main focus of this paper is what is going on in the D2D segment. And the D2D segment, it is showing that the bond market is actually one of the best laboratory that you can have in investigating how this market is organized, because it's very unique and rich. It is a market where you have pretty much all the options. So, and the question is, in a market where you have all the potential options, and now we will see which type of options, how much the working of this market is going, to facilitate liquidity provision in the D2C segment. And clearly this is the main reason of why we need to investigate the interdealer market. So the interdealer market, one of the characteristics of the bull market is that it is traded also in the, let's say, centralized limit order book, that is an exchange trade market provided by MTS. MTS is a platform that now belongs to, well, I don't know for how long, but anyway, it has been built up by the Bank of Italy in the late 80s. Then it has been, let's say, managed and sold to the London Stock Exchange from the 2000, I don't remember which year, later on. And now maybe because of Brexit is coming back to Europe, and it will belong to, let's say, the stock exchange in Paris. Anyway, it is a platform that is working very well. It's a centralized limit order book. There are not only the bond traded in this platform, but a lot of other sovereign bonds, like Italian sovereign bonds, French sovereign bonds, Spanish sovereign bonds, and so on. It allows the immediate execution of market order at the millisecond, pretty much, and it is pre-trade anonymous, so you don't know who are, let's say, trading or who are posting the order in the limit order book. But this is just one element of the interdealer market for the bond. The second one is that the bond has been traded also among the same dealers. So we are really limiting the analysis to dealers that we know had access to the MTS and trade in the MTX. So we are really limiting the analysis for the interdealer market to the dealers that are exploiting all the options. So one is, I say, trading in the MTS market. Second, they trade among each other bilaterally. And clearly, this is subject to the usual problem of the OTC transactions, so search friction and then potential bargaining powers of one dealer versus another. It is clearly not anymore anonymous as it is in the MTS, so you can do price discrimination. So the dealer 1, for example, can decide to charge a different price to dealer 2 versus dealer 3. So we have also evidence that they are trading in this segment. And then we have evidence also that they're trading via another segment, that is the broker facilitated OTC trades. So you see the transaction between dealer 1 and dealer 2 are intermediated by the broker, that in this case is just creating the connection, is not using any inventory, so it's not buying the asset for D1 and sell it to D2, it's just, helping D1 and D2 to meet. So pretty much is reducing search cost. And what he's doing is matching the trading interest and take no inventory. And on the other side is providing another important, let's say, information that is anonymous for the dealer, both before and after the trade. Because, so pretty much you do not know with whom you are trading. And this, it seems to be also another important aspect of this interdealer market. So what the bond market is facing, that is very similar to, as I say, the type of structure that you have for the Italian sovereign bonds, for the US Treasury market, for the French sovereign market, and so on, is a mixture of, as I say, the interdealer exchange MTS. By the way, this exchange, the interdealer exchange, is just a market for dealer. So customer cannot get access, or high frequency trader, for example, cannot get access to this market. You have only dealer that can trade in this exchange trade market. Then, you know, we are looking to, for the same group of dealer, the bilateral OTC trades, and then the trades done by the OTC, in the OTC trades by broker facilitated facilities. We have a database that allows us, because we know who are these dealers, and therefore to put together and really look to all the, let's say, the type of transaction that these dealers are doing, one with the other, either by the exchange, via the bilateral, or via the broker. So pretty much we are looking to this hybrid framework, and clearly, you know, we are asking several questions. So the first question is, why do we care? You know, we have tons of paper on over-the-counter market, also on corporate bonds. We have tons of paper on market microstructure of the equity market. So why do we need another paper on this? Well, on one side, because we think that, you know, the regulators and the regulation, as Carmine, by the way, stressed, is really trying to push versus more OTC transparency. And based on this, mostly post-trade transparency, we are talking about MiFID II, trace in the US that now is imposing also that all the transaction on the US sovereign bonds is in some sense, you know, collected first, and maybe sometime they will make this also transparent. But it is not clear if it is an advantage or disadvantage to make it transparent. In fact, if you're considering for the corporate bond market, they made it transparent quite immediately. For the US sovereign bonds, the Treasury and the US Treasury bonds, we are still waiting. It is already 2 years that they are collecting data, and they didn't decide yet if they want to make it available to everybody or not. On the other side, we know that the trading on organized platform is imposing, you know, post-trade transparency, and, you know, you have all the EMIR and swap market regulation and so on. But so far, our feeling is that the relative virtues of OTC market versus organized market is not fully understood. And it seems that clearly, you know, if you're looking to the theoretical approach, you know, the exchange trade market should be the most efficient market, the all market where everybody are trading with everybody. This will be the one that reach the best type of organization. But if you're looking empirically, you know, and in particular in the framework that I'm showing to you, there are these three options. And if, at least for the dealer to dealer, and if, you know, the exchange trade is the one that is dominating all the other under all the different dimensions of why you're going to trade, then we should have that. This is really the one that, you know, empirically we are observing as the best. But so far, it seems that, you know, it's not that one market, one type of trading facility is dominating the other in a way that is eliminating them from their existence. But we have for years, not just for a few years, but for already 30 years, the endurance of the current market structure, and even the change, you know, the technological change that we have observed in the last, let's say, 10 or 15 years, in the way in which, you know, you can trade, has not affected significantly the structure of this market. So, you know, clearly we need to try to give an answer on why we have this type of situation, why there is this preference, why you have this type of organization. And as I say, the German sovereign bonds is clearly a benchmark case, because on one side, it is one of the most liquid sovereign bond market in the world. And to give an idea how liquid it is, you know, we didn't have the same problem that you observe in the US Treasury during the COVID crisis that happens in March, we don't have this type of issue for the Bund, because I checked the data from Bundesbank again, and we are not observing, you know, the huge problem that the US Treasury market faced during the pandemic. Then it is a safe asset. So clearly, you know, you don't have the same issue as an equity stock or a corporate bond, that you need really to have specific information on fundamental values. But still, it seems that information matters here. Maybe order flow are the one that are the most important. And on the other side, you know, it is an extremely important market, because it's really one of the most important collateral asset, and it is pretty much the asset that every asset manager with euro exposure is going to hold. So, but then the question is, if it is so important, this type of sovereign market, why, you know, we need, of course, to try to understand better what is the structure, and you know, what are the costs of trading in this market, and what are maybe their fragility. Because, you know, it is true that even in this case for the COVID-19, it shows a very significant resilience. But on one side, maybe we need to understand why it was so resilient. And on the other side, we need maybe to understand better, you know, why it is in this way, why we are not having a different structure. From the academic point of view, it is also very interesting, because as I said, you know, if you are starting with the classical, let's say, approach to market, you know, the academic perspective is in some sense proposing that you should have an OTC premium. So trading in the OTC market should be more expensive than trading in the exchange. And I can, you know, cite tons of papers stressing this aspect, you know, and the key point that they were stressing is that if your shift toward exchange trading with pre-trade transparency and an all-to-all structure will significantly improve both market efficiency. This is the paper by Harris, Kyle, and Siri in 2015. We have a survey paper by BA and Green that provide evidence suggestion that transaction costs are higher in intransparent OTC market than in exchange markets. But in this case, they were comparing in alternative. So not in the presence of, not in the case where you have both this market together. And then, you know, this idea that there should be an OTC premium is that these results are in line with theory of pure OTC market, in which market friction drive transaction cost. So, you know, OTC market are characterized by a lot of friction, and this is why you have transaction cost. And these are the classical paper, Stoll 1978, or Duffy et al., Duffy, Peterson, and so on, Garlino and Peterson 2005. And clearly, in this case, all this friction that they are identifying the OTC market are search costs, bargaining power, some level of inventory costs that are also present instead in the exchange trades, in exchange trade market. But clearly, search cost and bargaining power are not or shouldn't be present in the exchange market. So clearly, in principle, the cost of trading in the exchange trade market should be lower, just exactly for this simple observation. There are no such costs or no evidence of price discrimination due to bargaining power. On the other side, there is this, let's say, a growing literature that instead stress the fact that there could be an OTC discount. And pretty much an OTC discount is consistent with the theoretical model that emphasizes information friction. So clearly, the presence of OTC discount is not coming from market friction like search cost and bargaining power, but is coming from information friction as the main difference between trading mechanisms in the hybrid markets. And they justify for this reason why you have hybrid markets. So the presence of both exchange trades facilities and bilateral trade facilities, because you know you want to try to reduce as much as possible information friction. On the other side, you know, you want also to try to avoid the cost that the immediacy provided by the exchange, it has not been faced in an over-the-counter market. So This is another reason of why you have the presence of hybrid market. So if I need the immediacy, I'm going in the exchange. If I don't have immediacy needs, then I'm going to the over-the-counter market. That's another possibility of why you can have that you have an OTC discount, because immediacy is costly, and immediacy is exactly provided by the exchange market. As I said, we have a perfect laboratory here to investigate the hybrid interdealer market, where we are looking, as I said, from the exchange segment, so MTS, interdealer, centralized limit order book, and then the OTC segment, the bilateral or by broker. So far largely unexplored, mostly for bonds and interdealer market. There are, to my knowledge, no studies about sovereign bonds and the role of brokers. There is only a recent paper now on the UK market on this regard. On the other side, you know, it is also important because our study, as I said, is also highlighting the role of the broker, not just in the equity market, but in the bond market, sovereign bond market. And it is also helping to investigate the relative role of the channel between OTC search friction and information and adverse selection, and how this is having an impact on the market design. So clearly the conflict between efficient interaction among dealers and dealers' demand for a diverse set of trading mechanisms. And the fact that we have this trifurcated market structure that is not just for the bond, but as I said, is present for US Treasury bonds, and for example, for the index CDS and so on. Clearly, it is telling us that we need to understand better what is going on, and you know, what are really the trade-offs that generate and guarantee the perdurance of this heterogeneity among trading venues. So, as I said, we are looking just to the interdealer market, and we are able to investigate this
Loriana,
question.
sorry.
Yes.
Would you like to stop here and take some questions?
Yeah, I will be very happy, mostly because, you know, I want to know what is your view. So, you know, your view is that the exchange market, the exchange trade market is the best one, or, you know, there is still a reason to have some over-the-counter market. So which of the theory that I'm presenting is the one most close to your view?
So the floor is open to comments and questions.
Yeah.
Before Loriana goes on.
You know, what is more convincing you? I will be happy to do a vote eventually. How many vote that the exchange trade market has to be the most efficient one? Because, you know, otherwise there is no reason to push on this direction if we are not convinced of this. Oh, we are. I don't know. Yes.
We could allow to do question in Italian, maybe to.
Yeah, it's fine.
As a icebreaker.
Ok, per incoraggiare diciamo, i più timidi possiamo anche prendere domande in italiano, soprattutto da parte di coloro insomma, che hanno un'evidenza sulla domanda posta da Loriana, insomma, ecco, perché fanno attività di vigilanza o perché studiano il tema.
Cioè, vogliamo un all to all oppure è meglio avere tante possibilità?
Loriana, direi che forse è meglio proseguire e magari le domande verranno alla fine alla luce della tua analisi successiva.
Certo, no, io vado avanti volentieri, però appunto secondo me il punto è proprio questo, cioè il fatto che non sia così chiara questa, diciamo così, questa alternativa fa capire che appunto è importante cercare di capire le diverse dimensioni. Okay, so I'm very happy that there are nobody, you know, having a completely and strong view about one or the other, because you know, it's happened to me that when I'm presenting this paper, either I find someone that say, come on, you know, it's impossible. We are in this situation of you know, having this hybrid market, mostly because there is a lobby behind the dealer that you know, they do not want that the structure is changing. And by the way, I can also say who is the guy. You know, Darrell Duffy is taking this position all the time that I'm discussing with him this paper. So it's not, you know, the last one. But then you have other people like Ingrid Vermeer or others that are largely working on market microstructure in the equity market. They say, of course, you know, the over-the-counter market is providing better prices. So why are you even asking this question? So it seems that there are two worlds that are not talking one with the other most of the case. Anyway, I'm happy to continue. So as I said, we are using these transaction data that are provided by Bundesbank, where you have all the trading involving any German financial institution. We have the time, the price, the quantity of the trade, and then we know if it is traded in the over-the-counter or in exchange. And we know also there was also other exchange on top of the MTS, but clearly the MTS is the one that dominates. So we are not considering the other because we're really peanuts. And we have the ID. This is the most important thing of the involved parties, so including dealer and brokers. And then we know if you know, it has been a buy or sell transaction, the one that it has been reported by the agent. And then we match this database with the one of the MTS. So at the end, you know, we are double checking that the information that we have regarding the trades of the MTS are also in this database of the transaction data set, and they are. So, you know, and the type of quality in terms of time and so on, and price, we do not find significant error in the reporting. So, you know, the results are quite, the data are quite reliable. And just to give an idea for the sample that we consider a trading volume of, let's say, pretty much 3 trillions of transaction in volume. And you know, for those that we know who is, and we were able to identify because it was a dealer, we have about 1 trillion and 500. And then we can identify pretty much D to D, dealer to dealer, about half of this, let's say, of this half a trillions of volume done by dealer to dealer, and the rest is dealer to customer. We are just looking to transaction above 2.5 millions because they are the transaction minimum level that you trade in the MTS. Remember that we want just to, you know, to interact and compare apple with apple. So we need to have at least the same option to trade in one market or in the other. And then here are the number. So you can see already that, you know, about 4% of the interdealer market is traded via the exchange, 20% via the bilateral trade, and 78% it is via broker. So clearly this is indicating that the vast majority of the trades has been done via the broker. So this is really the trading facility that is preferred so far by the dealer when they trade among each other. And if you're looking to the type of characteristics, you know, clearly you're selecting the trading with the broker mostly when you need to trade a large size, but you do have also small size trade via broker. So it's not that you have a dichotomy in this market. Large trade is with broker and small trade is all via bilateral or MTS, but you have a continuum among all of them. And then you have the D2C, where again, we know with whom they are trading. And if we are looking to transaction above 2.5 million, so clearly even in this case, you know, the D2C is not retail investor, but we're talking about people that are trading 2.5 million each time minimum. Again, we do have that the trade side is on average 60 million, so it's not really so small. And then we are looking to the cases where it is the customer that initiate the trade, rather than you know, they are in touch with either the dealer or the broker, and it is the broker that is calling them. So here is the picture of this data, and when you are pretty much trying to see how much of the market of the bond we are able to cover, we are able to capture about 15% of the trading activity in this market, because it seems that the average per day of trade is about 70 billions per day in this market. So the first part is the part related to the exchange, and we are pretty much, you know, we are looking to all the trades. We have the full limit order book, so we can extract the bid-ask spread, the depth of the book, the virtual price shift in one where to trade on the MTS. So we can have, in any case, the comparison of what will be the price if this trade, rather than being done in over the counter, everything else equal, will be traded in the MTS. And our data sources are then the auction result from the DFA and the bond characteristics that come from Bloomberg. Then we merge the MTS database with the one that comes from Bundesbank. So given that MTS data on the order book and so on are available from June 2011, we limit our data set from June 2011 till December 2017, but in any case, a lot of data. And we infer who is initiating the trade using the algorithm of Lee and Reedy. We are looking to the intraday volatility that again we calculated with the mid quote of MTS. We are looking to the inventory from transaction data, and network structure looking to again value centrality and relationship share using our data from Bundesbank. So the first question we are asking is, are OTC trade cheaper than the exchange? And we know that you have a significant part of the literature that say no, OTC trade should be more expensive because you know, it is more efficient trade all to all. On the other side, we have the theoretical prediction of the hybrid market that you know, stress that OTC segment allows for price discrimination and clean scheming. There is high adverse selection risk for liquidity providers on the exchange. In some sense, the OTC market is the ability to tap unexpressed order flow, and market order on the exchange provide immediacy. So clearly, these are all elements that indicate that the exchange can be more expensive. What is the empirical evidence? Well, yes, the OTC trade is cheaper. This has been shown by Dunn et al. And Colin Dufries from the CDS market. And then there are other papers by Bijon and Cathiosi in 2016 and Howe et al. In 2019, one in the Forex market and so on. How do we calculate or how we compare the price in the exchange and the price in the over-the-counter market? So we have the order book of the MTS, we have the mid price, we have the best ask or best bid, and then you have the price that we observe in the over-the-counter market. So clearly, if we have that the price that we observe in the over-the-counter market lies in this area, so it is below the MTS ask and is above the mid, it means that there is an OTC discount. So it is cheaper to trade in the over-the-counter market rather than in the exchange. If it is above, you have an OTC premium. And then having calculated this, we are normalizing by, you know, the best bid and best ask in the best bid or best ask and the mid price in the exchange in the MTS market. And the same applies for a sell trade. So at the end, we are really looking, so if the number is positive, if this difference is positive, it means that it's cheaper to trade in the over the counter. If it is negative, it means that you have a premium, so it is more expensive to trade in the over the counter market. And here is the result. Here is the distribution. So this is the best bid or best ask of the MTS. This is having an OTC discount, and you see the frequency is far significantly larger than in the case when you have an OTC premium. So there is evidence of OTC premium, but in most of the case, the majority is indeed showing that trading bilateral via broker, it is far cheaper than trading in the exchange. And the question then is, is there any difference between trading via bilateral and trading via broker? Well, trading via bilateral, it seems that even more, it is closer to the mid quote. So there is, you know, the discount is extreme, and among dealers, they just trade at the mid quote when they see each other. Instead, via broker, you see you don't have a significant fraction as the one for the bilateral trading at the mid quote, but there is a uniform, or let's say a significant distribution in the middle, and then, you know, something done at the best bid or best ask of the MTS trade. So if we, you know, the discount, so the mean of the OTC discount is about 40% in the dealer-to-dealer market, independently if we are looking to bilateral or broker. And then if you're moving between bilateral and broker, showing, but it was already presented in the distribution, at a discount that is about 25%, and instead via bilateral the discount is above 50%. You do have also a premium. You see the 5th percentile present a negative OTC discount, so it's presenting a premium, but you know, the 25th already is presenting a discount, the median is a discount, and so on. And then the question is, and clearly there is a huge standard deviation also among all the different transactions. And if we move to the D2C, even the D2C is facing a discount that is in some sense in between the dealer to dealer and the broker. So we have evidence, clearly this is just let's say single comparison. So we are not considering for characteristics, trade size, who is the trader, the type of volatility in that period, and so on. This is just statistics, but it's showing that you know, the D2C also face an OTC discount. So the trade done at the exchange in a significant fraction, let's say in the 80% of the cases, is more expensive than the one that you will face if you are trading over the counter. So this is the empirical evidence. And you know, the question is, why are we observing this? And then what are the characteristics of the OTC discount that is making it different from one transaction to the other? So, you know, for explaining the cross-sectional differences among the different OTC discount that the dealer are obtaining, we can use still all the theory coming from the OTC market due to bargaining power. So, you know, if I have an outside option, so easier it is the ability to trade on the exchange, lower will be this discount. Clearly, you know, if the trade size is increasing, then you have indeed that it is negative. The ability to negotiate with other dealer, you know, if I have immediacy, then you will have that the discount is lower. If instead, I have a preference and I will be treated very well, so having a significant relationship with the dealer will help me to have a larger discount. Direction of the market, if I'm trading in line with aggregate order flow, so I'm not helping the dealer to reduce inventory, then I will pay a larger discount. I will pay a larger price, so lower OTC discount. Or if there is a huge limit order imbalance, then again I will be penalized and get a lower discount. Then clearly the other thing is inventory that play a role, and the sophistication of the individual bargaining power, so dealer fixed effect. But clearly information are crucial to model the hybrid markets, and therefore we need to have that informal traders receive wider bid-ask spread. So this is why they prefer the exchange. And in order to hide, they are indeed doing order splitting. And we see that if they're doing order splitting, the dealer that is providing this liquidity recognize that they are doing order splitting and penalize them. Or the fact that larger is the price impact, larger than it will be the fact that I will prefer not to go in this market. And then, liquidity motivated traders receive tighter spread, so clearly again they have a preference for the over-the-counter market. So how are we going to investigate this question? Empirically it's not so easy, because clearly we're observing the final effect of all these different aspects. We are just observing price and quantity. We don't know what there is outside. And clearly the OTC discount received by a dealer is going to influence his decision in which venue to trade. So clearly I will trade more in the place that is cheaper, and it is cheaper in the place where people are trading the most. So there are two faces of the same coin, and by looking to the venue choice and the over-the-counter discount separately, we have a problem of endogeneity or sample selection bias. So in order to correct this problem, we are doing, let's say, a two-step regression where we follow the standard approach used by several other authors. So we have a first stage that consists in estimating the model of the venue choice, so a probit, and then a second stage where we are looking to a linear regression and relate the transaction cost variable, in this case the OTC discount, to all the exogenous variables that we think are relevant. And on top of this, we use the inverse mean ratio, that is the probability that you will trade this transaction in that market where you are observing this discount. So in this case, we are taking into consideration the endogeneity of the venue choice. Then regarding the venue choice, so we start with the regression on the venue choice, and in this case we are we are looking to the bilateral via broker on the exchange MTS, and we are doing then in two steps: one, exchange versus over the counter, and then broker versus bilateral. And here is the result. So one thing that we can see is that positive sign means that you have a larger probability to trade over the counter rather than MTS. So in this case, you have larger is the trade size, larger is the probability you trade over the counter, about 3%. 10% is if you're above 10 million. So clearly, large trade, no way. The exchange market is not providing an option. Then if you trade let's say a quantity that is fixed, 5 million, 10 millions, you have 17% of probability to trade in the over-the-counter, in the MTS market. Volatility. Larger is the volatility, larger is the probability that you trade over the counter, about 8%, 7%, that you trade, in the exchange, the minus in front, so it's lowered by 8% the probability you trade over the counter. The amount of trade of the dealer is not significant, but it is significant the inventory. So it seems that if the dealer needs to adjust its inventory, is larger the probability that is trading over the counter. But the probability in economic value is not so large. Order splitting, so if you want to hide, you are going in the exchange. And the order booking balance, then you are instead trying to go out and trade over the counter. And then clearly the characteristic of the market in that period do affect also the decision to trade or not in one segment or the other. For example, what is interesting to observe is that less liquid bonds like 2-year, 5-year, and 30 years are traded in the exchange because maybe surge costs over the counter are far larger, and therefore you prefer to trade in the exchange this type of assets that are not so liquid. Then the question is, okay, given that you have decided to trade over the counter, do you prefer bilateral or broker? So you can see that again, trade size is playing a significant role in the decision to trade via broker. So 40% of the transaction above 30 millions is in some sense increasing the probability to trade via broker, and 20% again from 10 to 30 million. In this case, having a dealer that is trading a lot, it is then having a larger probability to trade via broker. So this means that if you are central, is larger your probability to trade via broker. And if you have a lot of inventory to unwind, again, you want to have opacity, and in this case, you go via the broker. Again, in the case when you want to hide and yourself, so you're doing order splitting, then again, you are going to trade with the broker. And the only reason why you prefer to trade, let's say, with via bilateral is very difficult to disentangle. It doesn't seem that there are significant cases where for sure you are going to trade bilateral. The only one is when the trade size is peanuts, so it's far lower than 10 million. As we see, we have that indeed our prediction about the venue choice has been in some sense confirmed, and but on the other side, we need to go and check what is going on in the OTC discount. So for the OTC discount, we are using pretty much the same characteristics, and now we are looking to the OTC discount when with respect to bilateral, OTC, or via broker. So again, trade size is having a negative impact on the OTC discount, so it will be lower. Trading a large size is both in the OTC bilateral and in the via broker penalized, but as you can see, is penalized less by, let's say, if you trade via broker rather than bilaterally. If the volatility is very high, again, even in this case, so immediacy is more important, the OTC discount is far lower. And then if you want to unwind inventory, so for the trader that the dealer that needs to unwind inventory, then either he's penalized in OTC discount, but he's not penalized if he's doing it via broker. The other thing that we are looking is the price impact. So larger is my price impact, larger is then lower will be my OTC discount, because the other dealer on the other side knows that I'm informed. But again, this is less penalized by a broker. Order splitting, I'm informed, I'm less penalized by a broker again. Aggregate order flow, it seems that in this case, I will try to go via bilateral trade, but still I will be penalized with respect to the broker. That is even more penalized. And then again, market characteristics. Venue choice do have is relevant. Here we see is significant, but the results are still there. The other thing that we add here is what is the role of, let's say, the market power of the dealer. So we are looking to the top 5 dealer versus the bottom 5 dealer in terms of fixed effect, I'm sorry, in terms of volume. And we do see that the top 5 dealer, for example, are the one that when trade in this market pretty much bilaterally, you know, we are taking them from the broker, they are penalized. So I'm sorry, they're not penalized, they are getting a larger discount with respect to the top 5, the bottom 5 dealer. So there is still the possibility to express bargaining power if you're doing OTC bilateral trade. So then what is really the role of the interdealer broker? You know, on one side they're providing anonymity, and on the other side, you know, they are providing better intermediation service, so they are reducing search friction, and they are reducing the time that you need to wait before that you are able to trade. So broker trade might be more informed since they are anonymous. So you are, in some sense, trying to trade with broker for all these reasons. Just to be sure and show that indeed there is a difference between the price paid by broker and the price paid in the bilateral market, we are doing a matching sample. So we are really matching the same trade, the same size, the same, let's say, type of trader and so on. And then we are looking to the dummy if the trade is done via broker. And as you can see, we have a 14% lower OTC discount if you trade via broker rather than trading in the bilateral market. So at the end, you have this result that is not the cheapest market, the one that is getting the largest volume, because remember, the largest volume is generated by the broker segment. It is not, as I said, the cheapest one, but at the end, what these really traders are showing that they demand is anonymity and you know, opacity that only the broker side is providing in total. And just to give an idea of how relevant it is, this is the price impact that you can get after a trade, either in the MTS market or via the broker, via bilateral, or via the broker. This is how the order book of the MTS is adjusted after a trade. So the trade, the red one is an MTS, everybody are observing it, and clearly, you know, then the price remain at the higher level, so there is a significant price impact permanent. If there is a trade over the counter, still the order book in the MTS adjusts. So, you know, it's not that the order book of the MTS is not reacting to trade that has been done over the counter. It is reacting, but the price impact is far lower, and as you can see, still permanent in any case. What is amazing is that trade done via broker do not induce any significant change in the order book. So clearly, the dealer are able to distinguish informed trade versus uninformed trade that are the one, you know, done via the broker. And the price impact then is having this pecking order: exchange, bilateral, and broker. So clearly, broker are presenting lower OTC discount, so higher transaction costs with respect to the bilateral, but this seems to reflect the value of opacity and anonymity that they provide and superior intermediation abilities. So clearly, they are showing that there is a desire of dealer to protect themselves against price revision risk. And this means that this is why you need to have an hybrid market, a market where each type of trade will have the best, let's say, solution. And if you're looking, then I'm taking the other 2 minutes. what is going on in the D2C segment. So we are investigating the same question, you know, and clearly the D2C segment is reflecting exactly the same type of OTC discount characteristic that you get from the other. But on top of this, what is very interesting is that if you are a client that trade with a dealer, with a certain dealer, the dealer fixed effect, that is, so the dealer that is getting a benefit in trading in the interdealer market, it is transmitting this benefit also to its client, because its client will trade with an OTC discount that is 2%, let's say, larger than the other. The same applies if you're using another variable for the dealer, that is the trading volume. Or another thing is that not only, but it seems that this type of discount is far larger for, let's say, the volume of the dealer client pair. So larger is the volume that you trade with your client, larger is the discount that then you provide to your client. And this survives on top of the fact that you are trading either with a dealer having a lot of, let's say, market power, so able to exploit a very good discount in the interdealer market, but still relationship matters a lot in your transaction with your clients. But so this means that the clients they are affected by the same type of friction that affect the interdealer market. On top of this, they are affected also by the relationship between the dealer client pair. So larger is your relationship, lower is the discount, larger is the discount that you get from your dealer. So conclusion is that it is much cheaper for dealer to trade bond over the counter. Both bargaining power and counterparty information play a role in determining the magnitude of the discount and also the interdealer market, the size of the interdealer market. Exchange provides immediacy and outside option, so it's a sort of liquidity of last resort. And interdealer broker transact more than 75% of interdealer volume, providing opacity, ensuring against price risk revision. And D2C trades feature a similar large discount as interdealer trades. In the D2C segment, market information friction are playing a significant role. And on top of this, dealers' bargain position in the D2D market is in some sense then transmitted to the customer. And pretty much the microstructure of the interdealer segment is key for understanding then the trading condition in the overall market, because the friction that are in that market are the same that you observe in the D2C market. So for regulators, clearly there is all this effort to move versus a more transparent market with, you know, post-trade transparency and so on. But our results suggest that the over-the-counter market and exchange, as well as broker intermediaries trading, are playing an important role. And taking out one of these three from the combination will, in some sense, prevent some of the traders to trade as, in some sense, they are feeling comfortable so far. Clearly, there are also, some of them will be penalized because, you know, some of the clients that do not have relationship are penalized. We show this, but at the end, you know, you have, by guaranteeing all the options, you have the possibility to have immediacy, to have, you know, the possibility to avoid that you will be front run because of your information and so on. So pretty much, even if a centralized exchange market is socially optimal in presence of no friction, agent decisions for trading protocol are driven by their private incentives. And while our empirical analysis cannot shed light on the socially optimal market structure, our results do provide a novel insights of theoretical studies addressing this important question for regulator of fixed income trading. And when they are imposing rules, clearly they need to be very careful, you know, on what they are doing. So thank you very much, and I'm happy to listen to questions. Are you convinced? Are we missing something?
Thank you very much, Loriana, for this very interesting paper, which questions also some regulatory choices. That's very, very insightful, very interesting. We were trying, Luigi De Bernardis, my colleague, and myself to use Mentimer, this instant poll tool, to make questions and to gather some views on the main points made by your presentation. But first, I want to open the floor to questions, and then we will see whether we need to switch to this Mentimer tool.
Mm-hmm.
Hello, if I may.
Yes, please.
This is Simone Fioravanti from Consob, of course. Yeah, I have a question about the difference in prices between OTC and market. I wonder if this difference in price could somehow stem from the trading fees and the central counterparty fees, which when you trade on the market you have to pay, while you don't have to pay them on the OTC trades. Thank you.
Well, you know, here we are, if it is the trading fees, this can, in some sense, justify the low volume of trade, but I don't think that, you know, it is justifying this difference in price, because otherwise, you know, it will be even more if you have then these fees that you need to attach. Actually, on the other side, I would like to stress that maybe you have a benefit on the exchange, because you know the exchange is handling actually all your transaction, you know, even in terms of reporting and so on. So it should be, let's say, it's true that you have to pay, but you know that actually it's not so large. But you know, you will have a lot of facilities if you're doing the trade via the exchange rather than doing bilaterally and having to handle. But clearly this
yes. Yeah, I don't have a negative view on trading on exchange, of course. It was just a question about.
But, you know, this can just, the problem is that this can justify the low volume, but it's difficult then to justify the low, the price, because you know this means that the OTC discount is even more larger, because I'm not considering the fees so far in the exchange.
This is Carlo Milia, may I?
Mm-hmm.
Thank you. Just a question. Thank you for the analysis, very rich in several respects. And I have a question on the price discovery process.
Yeah.
You've shown that the price impact is more important in the case of exchange trades. But overall, there is evidence about the leading market and the price discovery process, which is whether the MTS or the dealer or the OTC trades. Thank you.
No, maybe I don't understand the question, you know. So you're saying that, so what I'm showing is that the price discovery is larger in the MTS market. So you're saying the MTS is the leading market, but if it is the leading market, why we have only such a few or small number of transactions? And why the price is larger?
Sorry, I mean, in the time of price discovery process, the question is whether there is evidence, not in your study, but probably in other studies, about which is the leading venue, whether the MTS,
which is the leading, where information are, yeah, you know, yeah, this is a very good question, and we didn't do this so far in trying to see which is the where the price is formed first. Yeah, this will be something that we are going to investigate. Good question.
Thank you.
Are there any other questions or curiosities? Or Loriana, is there a specific question you want to put to our audience that we can?
I have a question. What are you doing instead with the same data that you have as the one that I have from Bundesbank? You know, you have all the data for the Italian Treasury transaction.
We should write a paper with you.
Yeah, I would be happy, you know, as soon as you start to use them. I didn't see any paper on that.
Yeah, no, as economic studies unit, we are starting to use the transaction reporting data. You will see a brief analysis on the next report on the financial investments of Italian households. So, but your paper is inspiring for using also this data. Maybe somebody wanted to put a question. I saw.
Nadia, may I share the our instant poll?
Yes, please.
That's fantastic.
So, Loriana, we should have put it before your presentation, then afterwards, and see whether.
Yeah, exactly. But you know, if it is like this after, it means that
maybe before it was even more imbalanced,
Exactly. So it means I create more confusion than before. That's But this is very interesting. Yes, I like this thing. I didn't realize that you have this facility. Otherwise, we should have put it at the beginning.
Yeah. No, indeed. I mean, today we are kind of experimenting.
Yes.
I'm sorry that you are the first speaker of the whole program, but maybe you can come back at the end after all the other remaining 9 speakers have given their presentation. But anyway, Luigi had this wonderful idea to use this instant poll tool, and next time we will plan it well in advance. I mean, maybe we can agree with the speaker the questions he wants to put to
this will be very
the audience.
Good. Correct.
Yeah,
I think this will be a very good strategy.
No, but anyway, Lorena, if you want, if you have some questions that may help you in your, I mean, your study or that you can find interesting for future research, please feel free to send them to me. And we will try to make a kind of survey, in Consob or in ESMA. I mean, it could be an idea.
Yeah, no, because, understanding what regulator, I'm not saying about the regulators in general, but, practitioner from my point of view, at least, of this, of the topic that I'm investigating, it is for sure very interesting, Clearly, I'm not going to say, but it's helping me to think. That's what I need.
Yeah. Okay.
Good.
Very, many thanks. And we will keep in touch. I look forward to reading your paper on Wirecard. So please send it to me.
By the way, we are giving a presentation at the CPR webinar on this week in 3 days. But then if you are interested, we can also give a talk on this. So maybe after, after January that you have finished all this series of seminar, we will be very happy to provide. Because on the other side, clearly I know very well the Parmalat case. And in discussion that I did with my colleagues, in writing the Wirecard case, I say, yeah, but, in Italy, we did this already. Actually,
Yeah.
originally we were having a long section on how Consob have already addressed a lot of the issues that in Germany are still present. But then, you know, we took them out because we were some limit of space. But you will see that in the back there is this idea.
Okay, no, that sounds very, very interesting. So let's keep in touch and let's organize a talk in February, okay?
Yes,
Early February,
very good.
maybe.
Yeah.
You can give me some availabilities of yours and other speakers you may want to involve, and we'll organize that.
Yeah, I will be happy. Very
Okay.
good. Okay, thank you very much.
Thank you very much.
Bye-bye.
Bye-bye. Bye.
Bye.